Welcome to The Explainer. Today, we're diving straight into an investigative look at the hidden mechanics of the financial industry. We're going to examine the very forces that impact your portfolio every single day. Specifically, the things your financial advisor might not be telling you. If you've ever suspected that there are gears turning behind the scenes that you just can't see, well, you're in exactly the right place. So, is your advisor actually telling you everything? It's a pretty provocative question, right? But over the next few minutes, we are going to peel back the onion on some closely guarded industry secrets. We're stripping away the jargon and the complexity to empower you to confidently manage your own money. Because, when you understand how the machine actually works, you stop being a passenger and you start taking the wheel. Okay, let's dive right into this. Layer 1, the fee illusion. Now, fees are absolutely something advisors do talk about, but usually it's to kind of obscure the bigger picture of what investing should actually cost you today. In the bad old days of investing, and honestly, shockingly, even today in some corners of the market, you could be sold a basic S&P 500 index fund charging a scandalous 2.31% like Ridex. It's just brutal. You're literally paying a premium price for a standard list of stocks. But contrast that old reality with today. Industry giants like Vanguard, Schwab, and Fidelity have engaged in this fierce price war, commoditizing index funds and racing each other to near zero fees. Standard portfolio construction has become incredibly cheap. Just look at this incredibly low number, 0.03%. That is the expense ratio for Vanguard's S&P 500 ETF, ticker symbol VOO. That means for every $10,000 you invest, you are paying just $3 a year in management fees. I mean, that's less than the cost of a fancy coffee. I really want to emphasize this to drive home exactly how inexpensive basic foundational investing should be right now. If you're paying an advisor 1% or more just for basic market access, you are essentially paying for an illusion. Moving on to the next layer. Layer 2, the hidden tax bomb. So fees are really only the surface. Now we have to look at the invisible costs. Now, what's really interesting about this direct comparison is that we're looking at two funds that track the exact same S&P 500 index, Vanguard's ETF, VOO, and Fidelity's mutual fund, FXAIX. If you check out the top row, the Fidelity Mutual Fund is actually slightly cheaper on paper, 0.015% versus 0.03%. Sounds like a win, right? But notice the bottom row on tax efficiency. The mutual fund has a massive hidden vulnerability in taxable accounts that the ETF structure entirely bypasses. And that vulnerability, it's called a capital gains distribution. Here is how this mechanism actually works. When a mutual fund sells its underlying assets at a profit, maybe they need to rebalance, or maybe other investors are just cashing out, it has to pass those taxable gains on to you, the shareholder. They sell for cash, which triggers a tax event for everyone holding the fund. ETFs, on the other hand, use a really clever mechanism called in-kind redemptions. Essentially, they can swap shares out with institutional partners without ever triggering a cash sale. It acts like an invisible structural shield for your money. Let's ground this in a real-world example. In December 2023, the Fidelity FXAIX mutual fund distributed 35 cents per share in taxable capital gains. So if you held $100,000 of this fund in a standard brokerage account, you were suddenly hit with a tax bill for gains you didn't even personally realize. It eats directly into your net returns. Meanwhile, the ETF investors avoided this entirely. So let me ask you, do you know right now whether your advisor put you in an ETF or a mutual fund in your taxable account? All right, let's keep going. Layer 3, the active management illusion. Now we're going to examine the industry pitch for active defensive portfolio management. Active managers, like the folks at Hussman Funds, utilize complex strategies involving defensive hedging and options. As their own prospectus clearly states, their goal is to prioritize the preservation of capital over appreciation. Basically, they are actively trying to minimize your risk during unfavorable market conditions. And to be fair, that's a completely valid, clearly stated objective aimed at smoothing out the ride for conservative investors. But this brilliantly illustrates the long-term reality of that defensive posturing. Notice the dark black line climbing relentlessly upward. That is the standard S&P 500 index. Now look at the blue line at the bottom. That's the actively managed Hussman Strategic Total Return Fund. Because the fund heavily prioritizes defensive hedging against market drops, it drastically lagged behind the historical upward slope of the broader market. The numerical contrast here is just stark. Over this measured period, a hypothetical $10,000 grew to over $42,000 in the standard passive index. But in the actively managed defensive fund, it grew to just over $16,000. This really demonstrates the immense long-term mathematical drag that complex active management and constant hedging can have compared to simply buying a passive index and holding on for the ride. It's a mathematical reality that a lot of advisors who favor active management tend to downplay. Let's move to our deepest layer and see how this builds. Layer 4, the science of factor investing.
So if active management often lags and standard indexing is super cheap but kind of basic, is there a middle ground? Enter the science of factor investing, which is heavily utilized by firms like Dimensional Fund Advisors, or DFA for short. Instead of just blindly buying a static list of companies based on their size, DFA uses financial science based on Eugene Fama's Nobel Prize-winning research. They engineer portfolios to tilt towards specific dimensions that historically carry higher expected returns, things like small-cap companies, value stocks, and highly profitable firms. Plus, they use flexible trading. When a stock gets added to the S&P 500, standard index funds are forced to buy it all on the same exact day, which drives up the price. DFA is flexible. They wait for the best price, completely avoiding that invisible index tax.
A great analogy to understand the difference is this. Standard indexing is a lot like checking your oil once a year. It's totally fine, and for sure, it will get most people from point A to point B without a problem. But factor investing with DFA, that's like having a top-tier mechanic monitor your engine continuously while you drive. Now, because of this daily, highly engineered management, DFA charges a little bit more, usually 15 to 25 basis points, compared to Vanguard's near zero 3 basis points. But the whole argument here is that this continuous scientific optimization aims to compensate for the slightly higher cost by capturing greater returns over your lifetime. Finally, let's bring it all together. The core: building a simpler portfolio. So, the crucial point is this. We've looked at hidden fees, tax bombs, and the drag of active management. Let's strip away all that industry complexity. Here is a blueprint you can literally apply today. Step 1, keep your standard indexing expense ratios as close to zero as humanly possible. Do not pay for the illusion of standard access. Step 2, fiercely protect your net returns by using tax-efficient ETFs like VOO inside your taxable brokerage accounts to avoid those capital gains distributions. And Step 3, utilize a beautifully simple 3-fund structure to capture broad market growth without the headache. And if you want to optimize your asset allocation, you really don't need expensive active managers. The data shows that simple, cost-effective tweaks, like allocating 20% to real estate investment trusts, or REITs, alongside 40% stocks and 40% bonds, can historically create a highly efficient portfolio. In our source data, this exact mix generated higher expected returns with less volatility than a standard stock-heavy allocation. It's efficient, it's diversified, and best of all, it doesn't require a high-fee hedge fund. Which brings us to our final thought. I challenge you to look at your own statements this month and ask yourself, are you paying for genuine expertise, or are you just paying for complexity? Knowledge is absolutely the ultimate hedge against bad investments, and it exposes exactly what your financial advisor might be leaving out of the conversation. So evaluate your portfolio, ask the tough questions about fees, taxes, and structure, and take control of your financial engine. Thank you so much for joining me on The Explainer, and keep learning.